All right, let's dive in. Today we're talking about something unexpected. We're going to uncover this wild link between the future of AI and some, well, really old school stuff. Trust me, it's a connection that could totally reshape tech and energy. So let's get right into it.
Okay, so think about AI for a sec. What powers it? Your mind probably jumps to, shiny microchips, massive data centers, super smart engineers, all that, right? But what if I told you one of the most critical pieces of the puzzle is something we've been using for like over 100 years? What is the real engine hiding behind this whole revolution?
Believe it or not, it's pipelines. Yep, those steel tubes buried under our feet, pumping natural gas around. They are quietly becoming the absolute backbone of the digital age. I know, it sounds kind of crazy, but stick with me. By the end of this, you're going to see why this is one of the biggest stories in tech and energy right now.
And this gets us to the heart of the matter, what we're calling the AI power paradox. See, all these amazing AI tools we're building, they are unbelievably thirsty for power. We're talking about a massive, and I mean massive, growing demand for electricity. It's an energy crunch like nothing we've ever seen before. And look, this isn't just some theory. It's a huge priority at the highest levels of government. Just look at this quote from the FERC's chairman. It basically says the race is on. Powering data centers is now a national strategic goal. And that means regulators are ready to move fast, maybe even bend some of the old rules to make it happen. That's a big deal.
Okay, so if AI is this thirsty beast, where does all that power come from? Well, this is where the story gets really interesting. We're about to see how this super old-school infrastructure, these pipelines, are turning into the new toll bridges for the entire digital world.
Now, this whole toll bridge idea, it's straight out of Warren Buffett's playbook. The concept is super simple, actually. You own something that's absolutely essential, something that's incredibly hard for anyone else to build. It's like owning the only bridge into a city everyone has to pay you to cross. And as you're about to see, pipelines fit this model perfectly today.
So who are the big players owning these toll bridges in North America? Well, you've got companies like Enterprise Products, EPD, which is basically the textbook example of this model. Then there's Kinder Morgan, or KMI, which is being called a data center backbone. And for those looking for higher yields, you've got names like Energy Transfer and MPLX in the mix.
All right, let's crunch some numbers. This table gives us a quick look at these guys. First up, the PE ratio. That's basically how much the market is willing to pay for their earnings. You can see KMI is way higher than EPD or ET. Then you've got return on equity, or ROE, which is all about profitability. And wow, look at ET, around 30%. That is huge. And finally, debt to equity, which tells us about risk. Let's dig into what all this actually means.
Okay, so what the data is really showing us here are two totally different stories, two different kinds of bets. On one hand, you have enterprise products, EPD. Think of it as the steady, reliable value play. It's got a lower PE, it pays for its own growth, very stable. But then on the other hand, you have Kinder Morgan, KMI. That's the growth bet. It's more expensive because everyone is betting its massive gas network is going to be critical for both data centers and exporting LNG.
And I just have to come back to this number for a second. Around 30%. That's the return on equity for Energy Transfer. It's an absolutely incredible figure. Really shows you how insanely profitable these toll bridges can be. Now, they do take on a bit more debt to get there, but still, wow.
All right, that's North America. But this isn't just a US story, right? It's happening all over the world. So let's hop across the pond and see how things are shaking out in Europe and Asia, because the game is played a little differently over there.
So in Europe, it's really all about regulation and stability. You've got Engie, which looks like a pretty interesting value play. But then you have companies like Snam in Italy and Inegas in Spain. They operate more like traditional utilities, heavily regulated. That makes them safe, defensive stocks for income, but they're also facing a big challenge, trying to shift their old gas networks over to new stuff like hydrogen.
Whoa, okay, this chart tells a story. Over in the Asia-Pacific region, it's like night and day. On one side, you've got these really disciplined companies, often with government backing, like Semcor from Singapore and China Yangtze Power. Look at those returns on equity. Fantastic numbers. And then, you've got Adani Energy. Their ROE is barely over 1%. I mean, that's not just a gap, that's a canyon.
And there's a very good reason for that massive difference. The source material basically slaps a strong sell rating on Adani. Why? Well, for starters, they're loaded with debt. But the real kicker is their operating cash flow is deeply negative. In plain English, that means their main business is burning through cash instead of making it. That is a giant red flag for any investor.
Okay, hang on. Before we get to the playbook, we need to talk about this thing from Australia called franking credits. It sounds way more complicated than it is. Think of it this way. The company pays its taxes, and then it passes a credit for those taxes onto you, the shareholder. It stops the government from taxing the same money twice. For an investor down under, this is a huge deal and can seriously boost your real return. Just tuck that idea away for a minute.
All right, so we've covered a lot of ground. What does this all mean for you? How can you actually play this? Let's break it down into a simple investor playbook. There are basically 3 main strategies you can use to navigate this whole new energy world.
Here they are, the 3 big strategies. Number 1, go for reliable growth with the dividend aristocrats. Number 2, chase that high-yield income with the toll bridges. And number 3, play it smart with your taxes by using that franking advantage.
So, strategy 1, reliable growth. Here, it's all about consistency. You're looking for the dividend aristocrats. I'm talking about companies like Enbridge, which has hiked its dividend for, get this, 31 years in a row. Or Enterprise Products, with 27 straight years of increases. These guys are the definition of reliable, consistently rewarding their shareholders no matter what the market is doing.
Okay, strategy 2 is for all the income investors out there. If you want to maximize the cash hitting your account right now, this is your lane. You've got Energy Transfer in the US dishing out a huge yield of over 7%, and it's expected to grow. Or, if you want to look at Europe, Engie's offering a sweet yield of almost 6%. That's some serious income.
And this is where that franking credits thing we talked about comes back into play. This is such a great example. Look at these 2 Aussie companies. On paper, APA Group's 6.4% yield looks better than Origin Energy's 5.4%, right? But, and this is the key part, Origin's dividend is fully franked. So for an Australian investor, once you factor in that tax credit, that smaller 5.4% yield might actually leave you with more cash at the end of the day. It just goes to show, you can't always judge a book by its cover or a stock by its headline yield.
And finally, if you're not into picking individual stocks and just want an easy, one-stop shop, there are ETFs for that. If you want to bet specifically on those US pipelines, there's MLPX. If you want to go broader and own infrastructure all over the world, check out IGF. And if you just want cheap, broad exposure to the big US energy players, you've got XLE.
So let's wrap this up with one big question. The AI revolution is obviously here, and it's changing our world at lightning speed. But as this giant tech wave keeps building, maybe the smartest bet isn't on the AI companies themselves. Maybe it's on the boring, old-school stuff that makes it all possible. The picks and shovels of the digital gold rush. In this case, the pipes and wires. Is the real money in the grid that fuels it all? Something to chew on. Thanks for tuning in.